the Social Security lump sum tax strategy that most retirees miss. Before we start, you may see a few ads. Thank you for letting them play, so I can keep bringing you free, actionable retirement advice. Now let's continue. When you think of a lump sum payment from the government, you probably imagine a stroke of good fortune. But for the unprepared retiree, a surprise Social Security check can be the ultimate Trojan horse. Most people are completely unaware that if you delay your benefits past full retirement age, you have the option to request up to 6 months of retroactive benefits in one single, massive payment. While a $50,000 windfall sounds great on paper, it often triggers a catastrophic chain reaction in your wealth management plan. It can spike your tax bracket, push 85% of your benefits into the taxable range, and even trigger massive surcharges on your Medicare premiums that you won't see coming until it is too late. The reason this matters so much right now is that we are entering a new era of IRS scrutiny and shifting tax laws. With the sunset of certain tax provisions on the horizon, the way you handle a lump sum today will determine your capital allocation for the next decade. For the high net worth individual or the business owner, this isn't just about a one-time tax bill. It is about avoiding the permanent erosion of your compounding power. If you don't understand the lump sum election rule found deep in IRS Publication 915, you are essentially leaving a tip for the government that could have been used to fund a Roth IRA conversion or bolster your estate planning. The 6-month back pay trap. Let's look at the mechanics of how this works. If you are between the ages of 67 and 70 and you haven't claimed your benefits yet, you technically have earned those months of payments. When you finally go to the Social Security office or file online, the representative will often ask if you want your back pay. To a savvy investor, this sounds like a great way to improve liquidity management. You think, I'll take that $60,000 now and put it into the market. But there is a hidden cost. By taking that lump sum, you are permanently forfeiting the delayed retirement credits you would have earned for those 6 months. That is a 4% permanent reduction in your lifetime monthly income. When you run the internal rate of return on that decision over a 20 or 30-year retirement, the cost of that quick cash can exceed 6 figures in lost purchasing power. Furthermore, if that lump sum hits your bank account in the same year you are taking required minimum distributions or selling a business, you have created a tax nightmare. The IRS election that saves your balance sheet. This is where the strategy most retirees miss comes into play. The IRS actually allows for a specific tax optimization strategy called the lump sum election. Most people assume that if they receive a $50,000 check today, they must pay taxes on it at today's rates. However, if that check represents benefits for a previous year, the IRS allows you to calculate the tax as if you had received the money in that prior year, without actually amending your old returns. Why is this a game changer? Imagine you retired 2 years ago. In those years, your income was significantly lower because you weren't yet taking RMDs and you had no earned income from your business. By using this election, you can effectively push the tax liability of that lump sum into those lower tax brackets from the past. This prevents the money from stacking on top of your current year's high income, which could have pushed you into the 32 or 35% bracket. This is sophisticated capital allocation at its finest, yet it is rarely discussed because it requires a deep understanding of tax law. Leveraging the windfall for Roth conversions. Now, let's talk about the institutional way to use this money. If you decide that taking the lump sum is right for your specific cash flow needs, you shouldn't just let it sit in a low-yield savings account. A truly professional approach involves using that liquidity to pay the taxes on a Roth IRA conversion. One of the biggest hurdles to wealth building in retirement is the tax-deferred nature of traditional 401ks. As those accounts grow, they become a growing tax liability for your heirs. By using a Social Security lump sum to cover the tax bill of a strategic Roth conversion, you are essentially turning a government benefit into a tax-free legacy. You are shifting capital from a forever taxed bucket to a never taxed bucket. This is a powerful move for estate planning that minimizes future RMD pressure and protects your family from future tax hikes. Anticipating the Medicare cliff. We also have to address the IRMAA cliff. Medicare Part B and Part D premiums are based on your modified adjusted gross income from 2 years prior. If a large Social Security lump sum spikes your income, you could find yourself paying hundreds of dollars more per month for health care 2 years down the road. This is the hidden tax of retirement. How do we preempt this? By coordinating your Social Security claiming strategy with your overall portfolio allocation. If you know a lump sum is coming, you might choose to skip a capital gains harvest that year or delay a large withdrawal from your brokerage account. It's about looking at your financial life as a single, cohesive ecosystem rather than a series of isolated decisions. Comparisons to international models. When we look at global bridges to retirement, countries like Canada or the UK have much stricter rules around pension unlocking. In many ways, the US system offers more flexibility for the sophisticated investor, but that flexibility is a double-edged sword. Without a fiduciary mindset, it is easy to make a choice that provides short-term liquidity but destroys long-term asset-based lending potential. In the UAE or Singapore, wealth management is often built around sovereign wealth or mandatory savings. In the US, the burden of tax optimization is entirely on you. You have to be your own chief financial officer. Your 3-step action plan. If you want to master this strategy, here are 3 implementable steps you can take in the next 90 days. First, pull your Social Security statement and calculate your full retirement age amount. If you are past that age, call the Social Security Administration and ask for the exact dollar amount of your 6-month retroactive benefit. Don't commit to anything yet, just get the number. Second, sit down with your tax professional and run a what-if scenario. Ask them to model your tax return using the IRS Publication 915 lump sum election. Compare the tax bill of taking the lump sum as current income versus using the prior year election. The difference could be enough to fund a family vacation or a significant investment. Third, look at your tax bucket diversification. If the majority of your wealth is still in pre-tax accounts, use the next 12 months to map out a multi-year Roth conversion strategy. A Social Security lump sum can be the perfect catalyst to kickstart this process, but only if you have the liquidity management in place to handle the move. Summary and key takeaways. To recap, the Social Security lump sum isn't just free money. It is a complex financial instrument that carries a permanent cost to your monthly benefit. However, when managed with the right tax election, it can provide a massive boost to your current liquidity and act as a tool for long-term tax optimization. By avoiding the back pay trap and anticipating the impact on your Medicare premiums, you can navigate your retirement with the authority of a seasoned institutional investor. I want to hear from you. Have you ever been offered the Social Security back paycheck? Did you take it, and how did it affect your tax return the following year? Share your experience in the comments so we can all learn from real-world capital allocation decisions. If you found this breakdown of the lump sum tax strategy valuable, please click the thumbs up button to give us a like as a thank you for this deep dive. Make sure to subscribe to the channel so you don't miss our regular updates on high-stakes wealth management and retirement planning. Fresh videos on these subjects are uploaded regularly to keep you informed of the latest IRS changes. I am not your financial advisor. The strategies discussed here are complex and depend on your individual tax situation and filing status. Please seek professional advice from a fiduciary or a certified tax planner before making any claims or changing your retirement withdrawal strategy. Your wealth is a tool for your freedom. Don't let a lack of tax planning turn your hard-earned benefits into a liability for the government. I will see you in the next video.